As digital financial service providers expand across Africa, fintech firms must ensure that they have a solid risk, fraud, anti-money laundering, countering system and compliance framework in place. Between 2016 and 2018, electronic bank fraud cost lenders about $14.2 million, according to the Nigeria Electronic Fraud Forum. Strong risk and compliance framework includes, of course, among other things, a regulatory compliant Know Your Customer program, fraud prevention, detection, and monitoring program, a transaction monitoring process for timely detection, of course, reporting of suspicious activities. Let's take a look now. Payduna, which is a Dakar-based payment solutions provider, said this week that it had begun operations in Togo as part of its Francophone West Africa growth. Togo is the startup's fourth market in the region, and it follows its entry into Côte d'Ivoire and Benin Republic just over a year ago. The company offers a multi-channel payment gateway that allows e-businesses all over the world to handle payments from and to African clients via mobile money, money transfers, and credit cards using a single API. Democratic Republic of Congo, like other nations in sub-Saharan Africa, has restricted access to fundamental financial services. Only 14% of the population has a bank account, and only 25% of the population has an account with a bank or other financial organization. Digital financial revolution that has swept the rest of Africa over the last decade can't come fast enough for the people of Central Africa, especially considering the country's current mobile phone penetration rate of 47%, which is expected to rise further. Over the last 5 years, a slew of firms have emerged, including Flash International, the country's largest fintech and payments aggregator. So joining us live to discuss the growth of fintech across the African continent is Babajide Asegbeloyin, who is the head of a fintech business at FSDH Merchant Bank. You're very welcome, sir. Good morning to you.
Very well, thank you,
I want to start with know your customer. How important is it for fintechs in their growth to make sure that they nail down and lock down the know your customer protocols, KYC?
Yeah, I think KYC is one of the building blocks when delivering service because KYC is an important framework for compliance. It's also an important framework for preventing fraud and ensuring that your platform is not used as a conduit for illicit or improper transactions. And the reality is for KYC, know your customer, what fintechs must do is to ensure that they have the requisite technological infrastructure that enables them to identify customers, basically identify their behavior, identify who they are as much as they can. And the beauty about KYC is it also provides some level of intelligence when delivering value proposition to your customers. So beyond compliance, it also enables fintechs to understand who they are delivering services to so that they can continually and consistently modify services.
Fantastic. Between the BVN, the bank verification number, and the NIN, what's your overview of our, data structure for identification?
I think it's a fantastic step in the right direction. I think for NIN now, that's the NIN statistics shows about above 75 million in enrollment. For BVN, as at the last check, that's 2021, it's about 60 million. Out of the 120 million bank accounts. These data points have sort of helped the tech ecosystem, financial tech ecosystem, and also the banking system to critically identify customers, especially when it comes to credit. If you banked, let's say 20, 30 years ago, you would see scenarios, for example, in credit where an individual can have a credit with Bank A and also have with Bank C, Bank D, and none of those banks are aware that such exist. But with a strong identification system like the BVN NIN, of course it can get better. We hope that we get to a point where from birth, every individual has a level of identity, so just like we have in developed countries. And I think BVN NIN has also led to the growth of digital lending.
Speaking of lending, if you're not just lending as well as fintechs, we've got Payduna in Togo, fourth African nation that it's launched in. Flash International in, I think, the Democratic Republic of Congo. What do you make of the scaling of fintech services across the African continent?
I think it's just the typical DNA of fintechs. Unlike, and this is something I say every time, unlike the traditional corporates or traditional small emerging scale enterprises, fintechs, one of the critical elements of a fintech or a technology startup that is driving financial services is growth. So it's not surprising that services are being pushed across other parts of Africa. This is typical and is expected because when you look at the amount of funding that has come into the fintech space, I think 2021 was recorded that it's about $1 billion that came into Africa, and I think 3 billion into Africa, and 80% of this went into the fintech ecosystem. So it's expected that this growth will keep showing up, and I expect more expansion across Africa.
Great. So you expect the growth to continue, expect the expansion of Africa. What does that mean for banks? Is that a threat?
A fantastic question you've asked, and this is how I would answer it. It's only fintechs and their evolution and growth would only be threats to banks that are not willing to evolve and shake up from their extremely traditional systems. But fintechs are great collaborators to banks that have embraced the reality of innovation, technology, and fast-paced growth. I think, in my own opinion, fintechs or tech startups driving financial technology are fantastic partners for banks because banks may have legacy-based challenges, and fintechs, because of their appetite for risk, because of the generation of those who drive it, and because of their appetite for innovation, we can work together to deliver value to customers. So there's a form of shared value. From a threat point of view, yes, for banks that are struggling to evolve and catch up to the understanding that fintechs in the business space is like the emergence of Android. And we know what the emergence of Android did to some certain brands that couldn't quickly adopt that operating system. So banks, of course, must understand that technology startups driving financial services are a bit different from them. They need to embrace them, and also fintechs need to understand that I think there's usually a Yoruba adage that says, no matter how experienced you are, you can't have as much rag as an older person. So the traditional institutions are older, and they are fantastic experience they've gathered that the tech ecosystem can leverage.
I want to hold it right there. We're going to take a quick break and continue this fintech discussion. So do stick with us, Babajide. It's the Global Business Report here on Arise News. We'll be right back. Welcome back to the Global Business Report on Arise News. We continue our conversation with Babajide Asegbeloyin, who, of course, is the head of fintech business at FSGH Merchant Bank. So we're just talking right before the break about, competition versus collaboration between fintech companies and banks. Right. The customer that's in the middle, with fintechs on one side, banks on the other, whether it's competition or collaboration, are they the winners in terms of if you put financial inclusion into the mix? Are the customers the winners of all this?
Yes, at the end of the day, the customers are the winners, and they're the kings. And I think one of the things that should sort of make us see this clearly is, I won't call it just financial inclusion, but financial penetration. And you will see the expansion of mobile money operators all around. People call them Mama POS, Auntie POS. They are all in the nooks and crannies. And typically for banks that struggled with, or customers basically that struggled with withdrawing cash, maybe the ATM machine is some miles away, there's a lady by the corner that they can talk to. And most of these have been made possible because of some level of synergy between banks and fintechs, while banks are supporting, as I'll say, the big brothers. And the fintechs are, the younger ones that have the energy and are not so belabored with the legacy structure.
Now, since we're on that point, how do you scale financial services to the rural areas? That seems to be, it's a challenge that has existed for so long now.
Yeah.
How do we bridge that gap?
I think I'll look at it from two sides. When we talk about financial inclusion, we must first understand that for someone to be financially included, the person must have moved away from the radius of poverty. I think the more our people prosper, Nigerians, Africans, the more they prosper, the more they will get banked. It's nearly impossible for someone who earns below $1 per day to get banked. There's no balance from the person's cash flow to even allow the person to bank. So that's from an impact point of view.
Okay.
But from the technology point of view, we're seeing that there's a consistent growth in mobile phone penetration. We're seeing that we have much more affordable smartphones, and those smartphone penetration are really driving some level of financial inclusion. And what we would see is as that grows, as banks latch onto the communication ecosystem, which is like the easiest to latch onto because people must have phones, they must try to communicate. The more we latch onto that, the more we are able to deliver some form of financial value to the rural area. However, one of the key priorities is to see how the people in the rural area can be economically buoyant.
That is a very interesting point that you've made there. So you're saying if you think about the president wants, of course, to lift 100 million people out of poverty. We had, I think it was the World Bank said 7 million more people fell into poverty because of COVID and so on. So you've got to have some form of economic upliftment in order for these types of services to make way. So it's wealth creation and job creation. If you have that, then you increase your financial inclusion.
And that's basically, so typical example would be the cleaner in Lagos who earns extremely low incomes. And you tell the woman she should have a bank account. She really doesn't see a need for that because once she earns the money, she uses it to eat, take care of her kids, she's back to zero, she goes out next morning, then she's unbankable. And the classic case of banking is taking from what you call surplus and giving to those who don't have surplus as credit. That's classic banking. But I believe that with the aggression that tech startups, with the support of banks and regulators gradually, I think we are in interesting times, and all we can do is to ensure that we keep building up that infrastructure.
Well, that's very quickly. We have less than a minute to go. Can you get past the infrastructure deficit to advanced technology?
So nearly, it's tough. It's tough because of the challenges we do have. But I know that consistently we are tenacious. We're consistently tenacious, and with our tenacity and how much we are, determined as people, we would be able to, surmount the infrastructural challenges that we have. But I think the growth of the tech ecosystem over the years has proven to us that even with the infrastructural challenges that we have, we are able to still deliver some value. When those infrastructural challenges are surmounted, eventually, I'm sure we'll be running X10, X20, but we just need to keep working.
Great stuff. Babajide Asegbeloyin, Head of Fintech Business at FSDH Merchant Bank. We appreciate you coming in and talk to us about the Fintech space. Very dynamic space, lots going on there.
Yes.